I'm Charlotte McLeod with the Investing News Network, and here today with me is Nick Santiago, CEO and Chief Market Strategist at InTheMoneyStocks.com. Thank you so much for joining me online once again. It's great to see you.
It's great to be back. Thank you for having me.
It is, and it's been a little while. I think the last time we spoke was all the way back in January. And I wanted to have you back today because I think at the time, people weren't necessarily ready to hear what you had to say about gold. I remember back at the beginning of the year, you basically told us gold was going down this year. We could get down to 1,500, maybe even 1,450 per ounce, at which point that would be a big buying opportunity. So checking in with you now that gold is quite a bit down from where it was at the beginning of the year, is that still what you see coming?
That is still what I see coming. And I know back in January, nobody probably would ever think that would be the case. But here we are, and gold has fallen quite a bit. There'll be bounces, nothing goes down in a straight line. There are going to be bounces in gold, but I still believe that we're probably headed to that 1,500 area. If we breach 1,500, we'll go to 1,450, but down at 1,500, I will be a heavy buyer of the precious metal myself.
Okay, and those of people who know you know that you take a technical approach to the markets. So what is it, can you review, that you're seeing in the charts that tells you that gold is going to make this move?
Yeah, so back in January, you're going to notice that when gold was moving higher and everybody was all excited about it, you were into a very, very good double top formation. And just the natural ebb and flow of the way these markets work, you had a bottom in 1999 and nobody wanted gold back then, and it ran all the way up to 2011. And then we got a nice retest above 2000 again, but it's just not ready to break out. That resistance point was just too strong. Now, when you pull back to the 1,500 level, that's where the institutions have reset. That's where they'll be ready to load up. That's your technical buy point. And the unfortunate part is people that aren't listening to your program will not want it then. They will be afraid. That's just the way it works. They'll just get bearish, the metal. But that's when you have to get into it, when everybody hates it. And now you're just starting to see people throw in the towel. They're just saying, oh, this thing just doesn't go up. It doesn't go up. But when we hit that number, that's when you want to start getting into it. And that's just a very, very good pullback range from the prior attempt at a new all-time high. And it just failed. And it was supposed to fail. That's what technicals do. Now this will be your buy point, and we'll see how many people will be willing to jump on board.
Well, see, yeah, I remember you were telling us before about that 1999 buying opportunity. So we're still headed in that direction, it sounds like. And so you've talked to us about what you're seeing in the charts. If we look externally, I know this year a big headwind for gold has been the US dollar and the strength there. I believe this week we just saw it at a 20-year high. So I wondered if you could talk about your outlook for the dollar, what you're seeing there.
Yeah, well, the dollar is still very, very strong, but it's not because the dollar is so great. It's just the best house on a bad block, right? Or a bad street. Basically, the dollar is strong against every other currency in the world, right? So that's really what it comes down to. But as you get other areas or other nations starting to raise interest rates to fight inflation, that will start to put some pressure on the dollar strength. And then ultimately the dollar will pull back. But right now, the dollar is still very strong. As you know, the Federal Reserve here in the United States has vowed to raise interest rates. They need to catch up to where the 2-year Treasury note yield is, and that's now well above 4%. So the Fed still has a lot of work to do to get to that level before they can ease off of the tightening cycle. They are also no longer doing quantitative easing. They were buying $120 billion worth of US Treasuries and mortgage-backed securities. Now they're going to do what they call quantitative tightening, where they're going to sell $95 billion a month of Treasuries and mortgage-backed securities. So it's a little bit of a reversal there, and that's obviously the reason for the dollar strength. But the dollar is, not going up because it's so wonderful. It's just really going up because other places have not been aggressive and tried to fight inflation by raising rates. And they will. Now they will. You're starting to see central banks around the world starting to get more proactive in doing that. And obviously, once that does happen and it becomes a little bit more pronounced, we're going to see the dollar pull back.
Okay, thanks for that explanation because I think it's easy to forget that it's comparative, right? You're looking at the dollar versus other currencies.
That's right.
So yeah, so you were mentioning what's going on with the Fed, and I think we definitely need to go over that because this week we had the latest meeting. We got our hike of 75 basis points. I think that was widely expected. And Chair Jerome Powell was very adamant that they're going to keep going until this whole situation is fixed. I know a lot of the people I speak with are quite skeptical about how far the Fed can actually get. So I wanted to check in with you and see about your take on what's going on there.
Well, I think the Fed is holding true to what they've been saying. Many investors and traders are obviously looking for them to pivot. I mean, we kind of hear that news in the financial news networks all the time. Oh, the Fed needs to slow down. But it doesn't matter. They need to catch up to that 2-year Treasury note yield. Anybody that's been in this business 20 plus years like I have knows that. We really don't even need a central bank if we just let the Fed funds rate go right where the 2-year yield is. But apparently they don't want that to happen. So, this is where they are. They're behind the curve and they know it. Jay Powell's a very smart guy. He was, a former money manager. He knows his stuff. So he knows where he has to go. And again, it's just going to cause more pain for the market. We'll get bounces. There'll be some sharp rallies here and there. They may, twist their verbiage from time to time and, hint at subtle little things saying, hey, we may, let off the gas pedal a little bit, but they can't. They're behind. They put themselves in a box. And with the supply chain shutdowns and disruptions like that, they have no choice but to raise rates now. And they're going to. And that's going to put us into a recession. We've had an inverted yield curve between the 2-year Treasury yield and the 2-year note and the 10-year note. We have an inverted yield curve between 5s and 30s. I mean, there's no way really out of it now. They have to go the full course. And, again, there'll be bounces. If you're a savvy trader, you can play those bounces. If you're not, just sit it out and wait for this thing to bottom out. And then, you could get back in. But don't forget, too, the policy decisions in the United States are horrendous. I mean, we are looking at, terrible, terrible policy decisions. And then you have geopolitically war in Russia and Ukraine. You might get, you have tensions between China and Taiwan. We're seeing, potential tensions between Turkey and Greece. I mean, there's tensions all over the world, and this can also disrupt things as well. And that's why we see capital flows also going into the dollar. And again, there's a lot that can happen in the next few months, but I don't see a really bright outlook for the stock market right now.
Yeah, and I think, you're mentioning all these tensions, and this week we had that escalation and what's going on with Russia and Ukraine, all the other different things that you mentioned. And I think that is a little bit confusing, especially to precious metals investors who expect to see the metals react to things like that. And yet, as we speak today, September 22nd, we have gold below 1700. So any thoughts there?
Yeah, I mean, the correlations are probably doing it. As you know, I'm a technical trader first and foremost. I really don't follow the soap opera all that closely. So I've been expecting gold to go lower, but I'm very bullish on silver. I own silver. I just made a big purchase in the first day of the month in silver physical. I haven't made a physical silver purchase since March of 2020. So I think silver is starting to break out already. That chart looks amazing. So I think silver is going to lead the way. Gold will play catch up once it gets to that 1500 range. And what's going to happen, Charlotte, in my opinion, is that people are going to say, investors and traders, they're going to say, you know what, I think I need to hold a hard asset. I think I need to have something tangible. And that's when you're going to see, we're already seeing it in silver. Silver's already starting to break out. But gold has not done that, but it will once it gets down to that level. And what's going to be the catalyst, in my opinion, is simply that people are going to want to hold something tangible, something they could drop on their foot and it will hurt or they're going to own things like oil. They're going to own farmland. They're going to own something tangible. They're going to say, hey, I've had it with, stocks, which are really basically a paper product. They're going to want to have something, really rock solid. And that's where I think gold, silver, platinum is also looking really, really good. I was just in a platinum trade that I just got out of. So I think that's where you want to be. Silver is already making its move. I had a very, very good trade last week in silver, 60% in just a few days in call options. And I own SLV right now. So I'm really very bullish on silver. And like I said, when we get to that 1500 area, 1550, I'll be backing it up and buying gold there as well.
Okay, yeah, let's hear a little bit more about silver because I think I remember back at the beginning of the year, you told us $18 per ounce would be a key buying level for you. And we did get there just recently. So is that when you were picking up your silver? And is that the bottom now? We're on the way up, as you said.
That's right. I think that
Yeah.
is going to be the low for the more foreseeable future. In fact, I'm almost, I'm not going to say almost, but I think silver is going to go north of $30 from here. So, we'll probably see silver at 32, 33. Remember, the old high for silver is around 50, and I wouldn't even rule that out. I think silver right now is the play. If you ever read The Wizard of Oz, the book, not the movie, Dorothy taps her ruby shoes in the movie, but in the book, she taps her silver slippers, and I think they just got tapped. So again, I love silver here. It's my favorite of everything. And again, back then, last time, I guess that was January. I didn't realize it was that far ago, that long ago when we spoke. But I gave you that forecast of silver, and nobody wanted it down there. But I picked it up, and I made a substantial purchase there, and so far so good.
Okay, that's great. And I do love a good literary reference with The Wizard of Oz. So when we look at silver, I know that we have a lot of people who've been waiting for that $30 level, really have their eyes on $50 if we can ever get back there. Do you have a timeline that you're associating with these prices?
Well, the timeline on it is a little bit tough, but I would say over the next year, I think we could get to 30. And it may be a little bit sooner, but I think in about a year's time, we'll see it north of 30. In 2 years or so, I think we could even go higher than that. Like I said, I think this is the opportunity to get in silver right now. It's still, what I would call bottom basement bargain prices. This is still the level. It's just come off of that $18 Pierce, which is what I was looking for. That's exactly what I got. And, it had a very, very good move off those lows, and it's not going to go up in a straight line. There'll be pullbacks and retests, and, that's just the way technicals work. But if you're looking to get into it for the long term, this is the time to do it. And I would also encourage people also, you may want to buy some physical. I bought physical bullion. I bought coins. I really, made a substantial purchase down on September 1st. And I really think that is the bottom.
Okay, and so we've had the bottom in silver. We're waiting for that bottom in gold. Usually we tend to hear that those two move in tandem with each other. It sounds like they're a little bit dislocated now. Why do you think that is? Or are we maybe just thinking about it too simplistically to say that they move together all the time?
Well, there's always that ratio, right, between gold and silver. It's been out of whack for so long that I just go to the charts now. I don't really even pay much mind to it, because if you listen to this one or you listen to that one, they could get you all confused. Back in January, I gave you the targets of both silver and gold, not knowing which one would get down to the level first. And silver did it. So silver won. It won the race, and now it's off to the races. Gold still has a little bit of work to do, probably because of the strong dollar. But ultimately, gold, that you could already see the large institutions are already starting to accumulate it, and that's how it works. They do it in stealth mode, and then when it's time, it makes the big surge, and then the crowd starts to jump on board. But what I would say right now is I even like platinum. So platinum looks already attractive, and I've been in platinum twice since it got down to the 820 area, and I like that a lot still. I just got out of a trade, but I'll get back into that, and I'll continue to trade that as that has a lot higher to go. It'll go north of 1,000 pretty soon. So you just have to really pick your spots as a technical trader. Sometimes we have a little bit of an advantage because we're not listening to the story so much. We're really just waiting on the numbers. And like I always say, I like to just trade by the numbers. That's usually what does the trick.
Yeah, so keeping it nice and simple. When we have gold down at that level that you're looking for, how are you going to approach it? Because you mentioned with silver, you got some physical, you had SLV for gold. Would it be the same kind of mix of elements that you would use?
Yeah, I will probably, I will definitely buy call options on GLD or the IAU, and I will pick up both of those personally, and I will be buying physical as well at that level, whether or not it's going to be gold coins or I'll buy 10-ounce bars or something along those lines. But I will definitely be picking up physical gold at that level. And just so everybody knows, my physical gold purchases, I never sell them. Only the paper products such as GLD, IAU, call options, and I'll trade those. But the physical, I hold that for the long run. I started to do that in the early 2000s. People laughed at me, and I've never sold a single ounce. So I just want to let everybody know that.
And what about the gold stocks themselves? Are you seeing opportunities there, or you're not looking at that?
I am. In fact, I already own GDX, which is the gold miners ETF. I own Newmont Mining. I have call options in Agnico Eagle Mining. So I like the gold miners already, although they have struggled a little bit. But what they're doing right now is they're showing relative strength compared to gold. Gold is making new lows. The miners are not making new lows, and that's the tip off. Miners will usually will lead, especially in a big advance. So if the miners are already showing strength, that kind of confirms my theory for myself. And as I see that happening, I get even more conviction in that gold level when it gets down there. But I already like a lot of the miners, and I like silver miners too. By the way, I own call options in SIL, which is the silver miners ETF right now.
All right. So we know you like gold, silver, platinums in the mix too. Any other areas, not necessarily in commodities, but it could be that you feel optimistic about right now?
I like oil right now. So I was just in an oil trade recently. I'm looking to get back in. I think with the market volatility, maybe we'll get another little minor dip lower in oil, maybe 80 or Pierce of 80. But I love oil right now too. I just got out of an oil trade, but I'll look to put that trade back on. But I think oil right here is very cheap. Everybody loved it at 130. Nobody seems to love it in the low 80s. So this is where I like oil as well. So again, it's more of the complex of, you want to own things that are tangible items, oil, things that you're going to need for practical use. The heating season is coming up. I like gold and silver. Obviously, gold price around 1,500. We're not there yet, but you want to own things like that.
Okay. And on the flip side, just because this has been a very positive interview so far, really, are there any areas, sectors that you are staying away from right now that you think are just too risky and unappealing?
Yeah, I don't like tech right now. I think that's, an area where you got to stay away from. It's just, the Fed is raising rates. It's not a good backdrop for technology or growth stocks in general. So you kind of stay away from that. You stay away from, most things in the stock market. There's an old saying, birds of a feather flock together. They're all kind of going down, at the same rate. If you're savvy enough to pick one industry group over another, you could do that. But there are very, very few new highs being made in this market right now. So I think you just really let this market play itself out. If you're a savvy investor, you can play bounces because the bear market rallies are vicious when they do occur. But I really just don't like a whole lot right now as far as equities go. Maybe at some point I'll like Colgate and Church and Dwight and the consumer goods names at some point. I am watching some levels on those equities to get into. But again, those are just, trades, more safety trades, place to park money, and they'll perform as the market does poorly. So that's about it for now, though.
Right. And just as we look at what's going on in the broader stock market, you had an interesting tweet this morning that says bad economic news is bullish and good news is bearish. I wondered if you could explain what you mean by that to us.
Yeah, so the market's a little bit twisted sometimes, right? So it will go up when there's bad economic news in hope that the Fed will pivot. That's really what the market, and it almost, it sounds a little bit crazy, but that's the way it works. So if you get bad news, bad economic news right now, the market will say, "Ooh, things are so bad, the Fed's going to have to reverse course." And sure enough, it gets a bid, and that's the way it works. If you get great economic news, "Oh no, that's terrible. The Fed has to continue their hiking." So that's the logic that goes on in the market. It's backwards to what the average layman would think that's not inside of Wall Street. If you were, part of Main Street, you would say that doesn't make any sense. But that's kind of the way it works. Everybody right now is, I could talk to traders every day and they're saying, "Well, I hope it comes in terrible so the market could get a bid." So every economic report, um, it really is crazy. But bad news now is considered, good for the stock market, and good news is considered bad for the stock market.
Okay, well, thanks for helping us go through these interesting times. Before we wrap up, I wonder if there's any other final thoughts you would share with our investor audience.
Yeah, I would. If you're in this market and you know what you're doing, there's good money to be made, because these bear markets do give you really, really good bounce opportunities. But, every rally or every rip up should be sold into. And, you just find the institutional resistance points, and that's where you sell. Also, try to, take advantage of options if you can as well, because, this way you're not risking a ton of money, and you could also make a decent percentage gain if you're correct, and you're only risking your premium paid for the options. So that's kind of the strategy I like to imply at this stage of the game. But bear markets are tough. They're not easy. And, a lot of times I think people just want to be in the market, because remember, since March 2009, the world has been conditioned to buy every single dip. Every single dip. And even if you go back to December of 2018, Jay Powell did reverse course, right? He cut interest rates. He went to zero. He did a quantitative easing. He bought mortgage-backed securities. And, they obviously overshot. They printed way, way too much money. So watch the charts, learn the charts, and the charts will tell you what to do.
Okay, I think that was a great place to end on. Thank you so much for coming back to talk. And we'll check in with you at some point in the future about what's going on with gold and the other commodities that we've been talking about. Thanks again.
Thank you for having me. It was great to be on.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Nick Santiago with InTheMoneyStocks.com.